Axsome Therapeutics, the CNS biotech building a three-drug franchise aimed squarely at central nervous system disorders that have frustrated medicine for decades.
The company was founded in New York City in 2012 and went public on NASDAQ 3 years later, focusing entirely on developing novel treatments for CNS conditions.
CNS is notoriously difficult scientific territory. Most drug candidates fail, development timelines stretch by years, and commercial launches often disappoint even when pivotal trials succeed.
Axsome attacked that problem with a platform of multi-mechanism molecules, combining receptor targets that had never been paired together before in a single compound.
That approach paid off with Auvelity, an NMDA receptor antagonist approved by the FDA for major depressive disorder, a first-in-class designation in one of the largest therapeutic markets in medicine.
Auvelity generated roughly $110 million in its most recent fiscal year and is still in the early stages of a multi-year adoption curve with psychiatrists nationwide.
The company added a second product when it acquired Sunosi from Jazz Pharmaceuticals, a wakefulness agent for excessive daytime sleepiness conditions, including narcolepsy.
Then came Symbravo for acute migraine treatment, giving Axsome 3 distinct commercial revenue streams across 3 high-prevalence neurological indications, all served by the same focused sales force.
Total revenue reached roughly $190 million, growing about 65% year over year, exceptional velocity for a specialty pharma company at this scale.
Gross margins in the pharmaceutical business run near 85%, so each additional dollar of net revenue carries substantial flow-through potential as the company scales toward profitability.
Annual R&D investment runs around $180 million. That spend explains the reported net loss and reflects a deliberate choice to build long-term pipeline value.
That R&D investment funds 2 more pipeline assets, AXS-12 for narcolepsy and AXS-14 for fibromyalgia, both conditions where existing treatments leave a large portion of patients inadequately managed.
The competitive landscape in CNS specialty pharma includes Acadia Pharmaceuticals and Sage Therapeutics, but Axsome's 3-product commercial breadth is unusual for a company at this stage.
A focused specialty sales force covers roughly 50,000 psychiatrists and neurologists across all 50 states, keeping the commercial infrastructure lean relative to the total revenue it generates.
Market cap sits around $11.6 billion, reflecting strong investor conviction that the commercial ramp across all 3 products has significant runway remaining.
CEO Harriet Tabuteau co-founded the company in 2012 and has led it from early concept through all 3 commercial launches, the kind of continuity that matters deeply in science-driven organizations.
He came from drug development and clinical roles at Bristol Myers Squibb, so the scientific credibility underpinning Axsome's pipeline is grounded in direct, large pharma development experience.
The stock has returned nearly 100% over the trailing 12 months, making Axsome one of the stronger mid-cap biotech performers in the market during that period.
That is Axsome Therapeutics, a CNS franchise builder with 3 approved drugs, a funded pipeline, and a market cap that reflects serious and growing commercial momentum. I'm Hudson.
And I'm Lana. Thanks for spending time with us on Charged Alpha, the S&P 500 stock encyclopedia. Axsome Therapeutics just reported Q1 2026 revenue of $191 million, up 22% year over year, and the stock jumped 11.5% on the day. The EPS missed badly, but nobody cared. When a commercial-stage biotech posts that kind of revenue acceleration behind Auvelity, the market votes with its wallet. Today, we break down what that number really means.
Axsome Therapeutics was founded in 2012 and is headquartered in New York City. The company is a commercial-stage CNS biotech with 3 products now generating revenue: Auvelity for major depressive disorder, Sunosi for narcolepsy and excessive daytime sleepiness, and AXS-7, branded Symbravo, for migraine. The pipeline includes AXS-12 for cataplexy, targeting a high unmet need indication with no approved oral treatment.
At a market cap of $11.6 billion and a stock price near $227, Axsome is being valued as a commercial execution story, not a development stage bet. CEO Harriet Tabuteau has built a focused CNS platform with 712 employees. The central question every quarter is whether Auvelity's adoption curve is steep enough to carry the company to profitability before the balance sheet gets strained.
Q1 2026 headline results. Revenue of $191 million against consensus of $185 million, a 3.2% beat. EPS came in at negative 126 against the estimate of negative 85 cents, a significant miss. But the stock added 11.5% because investors are tracking the revenue trajectory, not the near-term EPS.
Why does revenue beat but EPS miss? Axsome is investing heavily in commercial infrastructure for Auvelity. The sales force, physician education, and payer negotiations all require upfront spending that flows through the income statement now. The revenue beat confirms the investment is working. The EPS miss confirms the company is still spending to accelerate, not pulling back to hit short-term earnings targets.
Auvelity is the engine here. It is approved for major depressive disorder with a novel mechanism combining NMDA antagonism and sigma-1 receptor agonism, a differentiated profile versus SSRIs and SNRIs that have dominated the MDD market for decades. The over 3 million treatment-resistant MDD patients in the U.S. represent an under-penetrated market that Auvelity is accessing for the first time.
On the balance sheet, cash of $305 million, total debt of $217 million, and total equity of only $55 million, reflecting the accumulated losses of a revenue-stage company still in investment mode. Total assets of $714 million with a current ratio of 2.5. Net cash position is negative $88 million on a debt minus cash basis, but the runway is intact through projected profitability.
Q1 cash flow. Operating cash flow negative $15 million, CapEx negative $1 million, free cash flow negative $16 million. TTM operating cash flow runs at negative $19 million. Against Q1 revenue of $191 million, the cash burn is modest, evidence the commercial business is approaching the point where revenue covers operating costs.
Annual revenue trajectory, $425 million in FY 2023, $650 in FY 2024, $728 in FY 2025, with consensus of $850 million for FY 2026 and over $1 billion for FY 2027. Operating margin improving from negative 65% in FY 2023 to negative 15% in FY 2025 and projected negative 8% in FY 2026. Path to break-even is Q4 2026 with positive FCF in FY 2027.
Analyst consensus is firmly constructive. 12 buy ratings, 3 holds, 0 sells. Average price target of $260, approximately 15% above the current price. The street is aligned that Auvelity's commercial execution is the determining variable. The debate is not whether AXSM wins, it is how fast the physician adoption curve reaches critical mass.
The revenue beat triggered positive commentary across the biotech analyst community. The key phrase appearing in multiple notes is launch trajectory. Analysts tracking week-over-week prescription data are seeing Auvelity scripts accelerating into Q2. That weekly script data is the real-time signal that institutional investors watch more closely than any quarterly earnings line.
The hold community, 3 analysts, centers on 2 concerns. First, the EPS miss confirms the investment spending is running above the pace required for near-term profitability, raising the question of whether the balance sheet can sustain the current burn rate if revenue growth slows. Second, the competitive landscape is evolving. Esketamine, ketamine clinics, and psilocybin pipeline drugs all compete for MDD mindshare.
The bull case from buy analysts is straightforward. Auvelity's mechanism is genuinely differentiated. NMDA antagonism provides faster onset, typically within 1 to 2 weeks versus 4 to 6 for SSRIs, and the oral formulation solves the access and monitoring barriers that limit eskedamine's market penetration. If AXSM captures even 10% of the treatment-resistant MDD market, the revenue impact exceeds current consensus.
Forward EPS estimates. FY 2026 at negative $3, FY 2027 improving to negative $150. The consensus is not modeling profitability until FY 2028. Any upside surprise to the revenue trajectory, particularly if Auvelity scripts inflect sharply in Q2 or Q3, could pull that profitability timeline forward and trigger a meaningful re-rating. That optionality is why the stock reacted so positively to Q1.
The bull case starts with the MDD market size. Over 16 million adults in the United States experience a major depressive episode each year. Roughly a third, over 5 million, have treatment-resistant disease, meaning 2 or more antidepressant failures. That is the exact indication Auvelity is approved for. At peak penetration, even a modest market share implies revenue well above current consensus models.
Sunosi and Symbravo provide diversification that the bear case typically ignores. 2 additional commercial products mean Axsome is not a single-product biotech, despite Auvelity being the headline driver. Each product adds prescriber relationships, managed care contracts, and commercial infrastructure that reduces the per-unit cost of reaching new patients.
The path to profitability math is the most compelling part of the bull case. Revenue growing 22% year over year, with operating cash burn running only negative $15 million per quarter, means Axsome is close to the inflection point where incremental revenue drops to the bottom line. At $850 million in FY 2026 revenue, the operating leverage should be substantial.
The bear case leads with balance sheet leverage. $55 million in total equity against $217 million in debt, and ongoing operating losses means the equity cushion is thin. If Auvelity adoption plateaus below consensus trajectory, the company would need to raise capital at a dilutive price, the scenario that keeps short sellers engaged.
Competition risk is real and multidimensional. Spravato esketamine from Johnson & Johnson holds the treatment-resistant MDD approval and has established reimbursement pathways. Ketamine infusion clinics have grown substantially and serve patients who want rapid relief outside the traditional prescription channel. If psilocybin receives FDA breakthrough designation or approval in depression, it becomes a third competitor for the same patient population.
Commercial execution risk is the most specific bear argument. Auvelity's novel mechanism requires significant physician education. Prescribers need to understand why this drug works differently from an SSRI and how to identify the right patient profile. If the sales force cannot efficiently convert those education conversations into prescriptions, the revenue ramp slows and the path to profitability timeline extends.
The EPS miss in Q1, negative 126 versus negative 85 cents, is a genuine warning flag. If spending runs above plan without proportional revenue acceleration, the operating leverage story breaks down. Bears want to see operating expenses grow more slowly than revenue for 2 consecutive quarters before accepting the bull thesis.
Axsome's peer group is commercial-stage CNS biotechs being valued on EV to revenue rather than PE multiples, since most carry negative earnings. Inva Intracellular Therapies is the closest comparable, a CNS-focused company with Caplyta approved for depression and bipolar, trading at approximately 6 times EV to revenue.
ACAD, Acadia Pharmaceuticals, trades at roughly 3.8 times EV to revenue with Nuplazid for Parkinson's disease psychosis. Praxis Precision Medicine focuses on precision neuroscience and trades at approximately 8.5 times EV to revenue given its earlier pipeline stage. Jazz Pharmaceuticals, with its broader CNS and sleep portfolio, trades near 3.5 times.
Axsome at approximately 13 times EV to revenue carries a premium to most CNS peers. That premium reflects the market's assessment of Auvelity's growth trajectory relative to slower-growing franchises at Inva and Jazz. The premium is justified if Auvelity continues its 20+% year-over-year growth. It compresses fast if that growth decelerates to single digits.
The peer comparison also highlights Axsome's execution differentiation. Among CNS commercial-stage biotechs, AXSM has the strongest revenue growth rate in the cohort, 22% year-over-year at Q1 2026, and is the only one with 3 commercial products simultaneously in growth mode. Multi-product commercial infrastructure typically commands a valuation premium versus single-product peers.
Options activity heading into Q1 2026 earnings showed a put-call ratio of approximately 0.7, a bullish skew indicating more call activity than put hedging. This positioning was prescient. The stock delivered 11.5% on earnings day. Call buyers at the 220 and 230 strikes captured the move. The bullish skew reflects institutional confidence that the revenue beat thesis would materialize.
Post-earnings, open interest built significantly at the 250 and 260 strikes on a 2 to 4 week horizon, investors positioning for follow-through momentum and potential analyst price target upgrades in the week following earnings. The options market is pricing approximately a 10% move for the next catalyst, likely Q2 prescription data or a pipeline update on AXS-12.
On insider activity, Axsome reported no unusual insider transactions around the Q1 earnings period. The company maintains normal 10b5-1 plan activity from executives consistent with a commercial-stage biotech compensation structure. The absence of open market selling at these price levels by insiders who know the Auvelity weekly prescription trajectory is itself a mild positive signal.
Institutional ownership reflects the revenue trajectory thesis. Major biotech-focused funds have been accumulating AXSM over the past 3 to 4 quarters as the Auvelity launch gained commercial traction. Ownership by specialist healthcare funds, who conduct detailed channel checks and prescription data analysis, provides fundamental support for the current valuation premium versus generalist investor sentiment.
Axsome delivered what the bull thesis requires. Revenue beat confirms Auvelity's adoption trajectory is intact. The EPS miss is noise at this stage of the company's life cycle. The stock reacted correctly.
Watch Q2 prescription data and the quarterly revenue figure. If Q2 revenue hits $200 million or better, the path to $850 for FY 2026 is clear, and the profitability timeline comes into view. 12 buys, 0 sells, 260 target. On the radar. Financial data and charts sourced from Financial Modeling Prep. Charged Alpha is for informational and educational purposes only. This is not investment advice. Always do your own research before making investment decisions. Thanks for listening to Charged Alpha. Subscribe and leave a review if this was useful. New episodes every earnings season. See you on the next one.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.